All right, here we go. We're going to talk about selecting high probability trades using autopilot, something we can do in just minutes a day. We have a secret strategy we like to use, and it's probably something you have not seen before. So we are recording the webinar, like I mentioned. You will receive a link to the recording, and it does expire Sunday evening. So with that said, let's talk about speculating. Maybe you've seen Trading Places Duke and Duke teaching Valentine about speculating, accepting risk, hoping to profit on price movement. It is important to take a look at the risk disclosure. Just be aware that all funds committed should be risk capital and that past performance is no guarantee of future results. So let's get a little context here before we get started. Jeremy Grantham predicted the 2008 financial crisis. He suggests the next 20 years we're going to see only 2 or 3% real returns in the stock market, in the US market. And here's something, a new MIT study, just saw this the other day, 70% chance of recession in the next 6 months. So they created an indicator looking back at data to 1916, and that indicator rose leading up to every prior recession when their index or their indicator topped 70%. And that meant there was a likelihood of a recession in the next 6 months of 70%. Well, as of just a couple months ago, their indicator is at 76%. Very interesting. Here's AQR. They manage, I think it's over 40 billion. It might be a little bit more than that now. They suggest future returns are going to be soberingly low. Unappetizing menu of low yielding assets, expecting a real return of traditional US portfolio to be 2.4% in the next 5 to 10 years. And one more here, stocks headed for a 67% downturn. Seems preposterous now, but it also did in 2000 and 2007. They're suggesting here conventional passive investment mix will deliver a negative nominal return over the next 12 years. That's from John Hussman Strategic Advisors. So I'm just giving a little context, that not to paint doom and gloom, but to suggest that we need to look at some alternatives. We shouldn't perhaps rely on the next 10 or 20 years to be as good as the last 10 years when it comes to stock investing. And maybe that's something you can agree on. But remember, markets are always right. We aren't. It can be expensive trying to convince the markets that your opinion is correct. It's from Market Wizard Ed Sequoia, great book by Jack Schwager. So we want to trade within the environment that the market offers us. We don't want to fight the trend or fight the market. So we're going to look at a new approach, something where you don't always need to be 100% correct. You have a lot of room for error, so to speak, something we can do in minutes a day. We don't need to have precision with picking markets or timing or entries and exits. So our agenda today, we're going to look a little bit about who we are, 3 common barriers to trading, look at indexes versus stocks, looking at probabilities, high probability trading secrets. We'll have a live demonstration and trade alerts as well. We'll talk about that. Then we'll have a special offer. It is a live webinar, and we'll jump into some FAQs. A little bit about us. We are AltaVest since 1997. We're an introducing brokerage firm. All of our staff are licensed, of course, with at least 25 years experience. We're futures and options specialists, traded millions of contracts. We're regulated in California and Illinois. There we are, some of our colleagues down on the trading floor at the CME group and near the options pit there. And things are different now. It's not nearly as busy on the trading floor, and that's part of what we're going to talk about and part of how we function within the electronic space. So speaking of experience, we think it does matter. We've been a big part of the growth in the E-mini S&P 500 option space in particular. That's what we're going to talk about. So we've learned a lot of what works, what doesn't work. This kid's about to find out that does not work. And we like to think of it perhaps more like Thomas Edison. We haven't necessarily failed, just found many thousands of ways that don't always work. So who am I? I am Eric Gebhardt. I've been doing this about 29 years now, it looks like. Co-founder of AltaVest, and we I started in the business in 1991, regulated, of course, and I have my BS in business administration from the University of Southern California. Sometimes people want to know how I got started, so here you go. That's my textbook from my financial investments course, one of the many we had to have when I was at USC. And then we were studying options and futures at the time, and that's my chapter there on Introduction to Options Markets, and you can see all the underlining. So I thought it was very interesting. We were studying crude oil. It had doubled in value upon the invasion of Kuwait, so we're looking at that sort of as an object lesson at the time. Very interesting. I did get started in the securities industry shortly after graduation with my securities licenses, but the futures and options markets, I guess you could say, kept whispering in my ear. And so I was able to get a job at an options trading firm where I learned all about spread strategies. And here we are today. So let's go ahead and get started. Let's try to put those text messages away. And I know we all tend to do that, and I'm guilty of it too, but we'll use our time wisely. I think you'll enjoy the demo of this unique approach, and stick with us till the end. We're going to have a special offer, something over $18,000. You can get it for next to nothing with a 30-day guarantee, and you can even participate for free. So with that said, and with my introduction out of the way, what I'm going to do is turn off the webcam. That way we have more real estate to work with on the screen. Okay, so 3 common barriers to trading success, these hurdles we need to cross, the contradictions we face every day. Here's Morgan Stanley on recession watch. And then here's another article on the same day, no reason to fear buying the market at new highs. All right, fair enough. But how do you really process that information, and how do you invest with it? What about mutual funds? What if you just buy the top ranked mutual funds, the 5-star funds? Well, it turns out there's a recency bias according to the Wall Street Journal article, the Morningstar Mirage. If you had a 5-star rating, only 12% of those 5-star ratings did well enough over the next 5 years to get a top rating again. And then 10% got a rock bottom rating. So past performance is not a guarantee of future results. And you can see here on the screen, all the 5-star funds converge to about a rating of 3 after a period of 3, 5, and 10 years. Then if you're a 0-star, or a 1-star, you move up to about 2. So everything converges to average over time. So what makes it so difficult to pick the right fund or market? Well, you have to be correct with the correct market, of course, and the direction, and apply the strategy at the right time and the right price, and you have to exit, whether it's for a win or a loss. So you have to do that all correctly. It turns out monkeys might be better at doing this. Simulated test here, the average monkey outperformed the index by an average of 1.7% per year since 1964. So there is the best money manager that perhaps money can buy. It's because of our emotions. We get in our own way when we're investing. I'm sure you've all experienced that, the hope, the greed, the anxiety. We have bad wiring. We have a built-in bias to make poor decisions like selling the lows and buying the highs. That's what Mark Lindheim is basically saying there. Unnecessarily overcomplicate matters, like build charts like this. Looks great, but I don't know what to do with it. So we need to break through, simplify, break through those hurdles. Let's look at stock market indexes and individual stocks. You're all familiar with an index. We're going to go over this very, very quickly. Index represents an entire stock market, such as the Dow Jones Industrial Average, the NASDAQ, and the S&P 500. The S&P 500 was the 90 until 1957. Now there's 500 stocks like Coca-Cola, Kellogg, Chevron, and then Warren Buffett's Berkshire Hathaway, considered the best representation of the US market. Here you can see all of the historical data on the S&P 500. You can see the clearly upward sloping trend as the economy grows, so does the S&P and vice versa. But along the way, there's a lot of volatility, and that's quite normal. But you do see here those last 10 years, that is quite a run up. Very similar to the mid 90s up to 2000. I think it was March of 2000 was the high. So why track an index? Well, it's convenient. You don't have to follow thousands of different stocks or ETFs, it's less volatile. A big move in an index might be 3% in a day. I don't think I've seen that in quite a while, actually. But individual stocks, as you know, move 10, 20%, 50% routinely, day by day. They can be volatile. Here's TD Ameritrade versus the NASDAQ. Remember that a few months ago? I think it dropped something like 30% in a day. The NASDAQ, meanwhile, just kind of yawned. They also can be non-correlated. Index moves one way, and the stock can move another way. This is just from the other day. The NASDAQ made a new high, and you see Tesla, I think, was down almost, was it 20%, I think, yesterday? So you've seen that all happen. What about probabilities? Let's look at casinos and insurance companies, how they use that to their advantage. Well, insurance companies collect our premiums, and they are paid to assume and manage risk. They sell time effectively, is what they do, and they manage that time. But they do insure themselves by hedging their positions. But they are consistent and patient in their plans, and they know that math, the probabilities in the long run will favor them. So they just use statistics, things like actuarial tables, look at concepts like expected returns. We can apply some of these same thoughts and concepts to options trading, but before we do, let's look at how casinos view things. Roulette, we're all familiar with that. You spin the wheel, hope the ball lands on your number. We'll see why it's not a smart game to play. So you have 38 numbers on the wheel. If you were to bet $100 on that green zero right there and spin it 38 times, if you did that enough times, you would win once, but lose 37 times. That one winning trade would be $3,500, but all the other losing spins, you would lose 3,700. Your net loss would be $5.26 on average. And guess who wins on average? The house or the casino. So that is their edge. You end up paying them an edge. So you play long enough, and that is going to be your loss becomes their edge. And even though they know they will pay winnings at times, in the long run, the casinos keep playing those games because the probabilities favor them. It's a law of large numbers. So it says here the average of results obtained from a large number of trials should be close to expected value and become closer to the expected value as more trials are performed. So you flip a coin a million times, you'll have 50% heads and 50% tails. Flip a coin 10 times and you might get 9 heads and 1 tail. So that, I think, is all something we're familiar with. But higher probability, let's look at an analogy for baseball. Looking at base hits and not hitting home runs or grand slams. Here's a baseball champion, batting champion, Rod Carew. He hit no home runs. So imagine that. The best batter in the league with no home runs, batting titles, MVP, on and on and on. So he hit lots of base hits. He didn't hit grand slams and home runs. So what about high probability option strategies? We can collect premiums. This is what we refer to as those base hits. By selling specific options, we need to be consistent and patient when we do this. We need to manage risk, expect to have losers, manage that reward. We don't get greedy. We need the proper tools. So remember, we're not swinging for the fences. These are called credit spreads, and these are always insured positions with predetermined risk and reward, and they can also be non-directional in nature, and we will show you how that works. The maximum reward on any credit spread is the net premium you collect, including the commissions, of course, and the maximum risk is the difference between the short and the long strike price minus the premium you received. And we'll show you that in a graph. It'll be very clear. And remember, with an option spread, you're looking at one net price. So when you talk about trading a spread at, a particular X price, it's all those options combined at one net price, trading as what we call an object. So you have 2 options, might be 2 legs, 3 options could be 3, 4, 5, 6 legs to an option spread. So what are the advantages of a credit spread on a stock index? Well, we call it the margin of error. The highly technical term we like to use is wiggle room. We know an index is less volatile. So you can see in this example, here's the S&P 500 trading mostly sideways to a little bit higher. And then you know that when we place these types of spreads, we're going to show you why, even though the market might move towards your upper boundary or lower boundary of an option spread, if you're selling a spread, the value still can work out favorably for you, and we'll show you why. And let's get into the Greeks. We can go really deep into this, but we don't need to. Other people probably are much better at that, but most people don't have to spend 8 hours a day analyzing Greeks and volatility. So delta, percentage change in option value compared to the change in the underlying asset. And let's look at an example, it'll be clear. Here's the S&P at 3120. Here's a 3090 put at 15 points, the delta is 0.25. Imagine the S&P drops to 3110. It drops 10 points. What happens to the value of that 3090 put? It was at 15. Well, now it's at 18.75. It gained 25% because of the 0.25 delta. So that's how the delta works. Delta at the money is 50%, deep in the money, 100%, deep out of the money options have a very small delta, maybe 1 or 2%. Now here's the best part about delta, and maybe the secret some people don't know about. It's the approximate probability of expiring in the money. So that 0.25 delta on that option we just looked at has a 25% chance of expiring in the money. But the converse is also true, where that means 75% chance or likelihood of expiring worthless. And remember, delta is always moving with price and time, and it does not represent the probability of a winning trade. Now, what about time? Well, let's talk about time decay. As you know, every option is a wasting asset with a limited lifespan. So that's referred to as theta, 1 day of time decay. So as the clock ticks, you're going to lose value on those options, and that's expressed as a negative number. So here's a premium of 10. Theta is negative 0.05. That means the next day that value would be 9.95, and after that 9.90, and so on. So unless the underlying asset is moving favorably and quickly enough, every out of the money option is always 0 at expiration. So theta decay is what gives credit spreads this room for error, or this wiggle room. So as you see time moving closer to 0, the premium value starts to drop, and quite rapidly in the last month or so, month or two of the option's lifespan. So if you trade credit spreads and sell them and collect premium, you hope to be a really boring trader. So the whole idea is to sell out of the money credit spreads and watch time pass, and then hope that nothing dramatic happens. But of course, we know it's not that easy because things happen, life happens. So let's look at a credit spread called a bear call spread, bearish to neutral. You collect premium by selling a call, and then you limit risk and you buy a higher strike call. And this is what it looks like. So here's the S&P trading away, sitting here around, let's say 3,300. You decide to sell a 35.30 call represented by the red line, and you receive 4.5 points for doing that. You ask, well, how do I sell it? Easy, you just click, instead of buy, you just click sell. Just that easy. And then you, at the same time, buy a 35.50 call, and you pay 2.25. So the net that you collect is 2.25 points. And in this case, it's $50 a point. So it's $112.50 is how much money you collect by selling this out of the money call spread. Perhaps your outlook is that the market's getting a little top heavy, or maybe you think it's going to flatline a bit. And that's why you're collecting premium by selling that spread. And looking at a put spread, just the same thing, but the opposite. Here's the S&P trading around 33.30. You sell a 29.90 put, receive 3. You buy a 29.70 put for protection, and we'll show you how that works. You pay $1, so you collect 100 points, including your fees, and that's how that works, selling a put spread. These are not naked options. I just talked about that, how you always want to buy an option to cover the one that you sold. So you do not want to be naked like this poor cat here. Very good. So here's an example. S&P is around 28. This is from a couple years ago, but I think it's kind of fun to look at this as what not to do. And let's say you decided to sell a 25.85 put, thinking, well, market's going to stay up here, it's going to go higher, so I'm going to sell this red line, 25.85 put, collect some premium. Well, look what happens. The market subsequently dropped 235 points. And if you were still short that put, that naked put, you'd be sitting on an open loss of almost $12,000. But had you bought a 25.65 put at the same time, your maximum risk would be no greater than 20 points. So that's a dramatic difference. And of course, you have to pay a little money to buy that put to hedge the short put there by the red line, but nonetheless, your risk is unlimited when you're selling those naked options. So never sell naked options. We wouldn't do it. We don't think anyone really should. And also margin calls. You can have margin calls when you're selling naked options. The way we do it, you don't have to worry about that. Let's look at an iron condor strategy. Maybe you've heard of this. It's just a combination of the put and call spread. It's a non-directional strategy. So you sell a call spread above the market, sell a put spread below the market, and you hope to see the index. And when I say market, usually on the S&P 500, and you want that index to stay between those boundaries, and that way you collect the premium on both sides. Now here is a secret strategy. It's called the dragonfly. If you haven't heard of it, it's because we actually named it years ago. It's a variation on a condor, and it has 6 options. This is what it looks like on the graph, and we're going to take a real deep dive here, but you're selling 6 options. You'll notice right away the red line are the ones you sell. So you're selling these 4 calls, but you buy 1 call that's much closer to the money. In fact, this one is 40 points closer to the money. So that means the ones that are closer to the money are going to hold their value and perhaps even gain in value a lot quicker than the out of the money calls and puts. And we'll show you how that works. And there's also half dragonflies. Let's take a look here. So you could do just one side of the trade if you wanted to sell just the call side of a dragonfly. Or of course you could do the same thing with puts, selling the puts as well. And then there's something called a bear hedge. This is one we like to use on occasion. It's a combination where you're essentially selling an out of the money call spread, and you take the money that you collect from selling that spread and then you buy an out of the money put spread. So there you have a bear hedge, and you could also do a bull hedge as well, just the inverse of that. But options, we know there's a multitude of combinations and permutations of possibilities of what options to choose and how to build a spread. In fact, here's a little animation from the CME group. This is just one option expiration on the E-mini S&P 500. You see the strikes here, puts on the right, calls on the left. You can see all the different pricing, and how would you know where to begin in terms of which options to choose? So that is what we are going to show you. And so we look at the ES futures options. That's the market we're trading. There are weekly, Wednesday, Monday, monthly, quarterly, end of month, at least 3 option expirations available. All right, let's see here. So how do you know which option trades to make? That's the question here. That looks like, I think that's Jackie Chan, isn't it? And by the way, can everyone hear me okay? If you could just type in, I want to make sure the audio is working. Someone had mentioned that they couldn't hear. It looks like everything's working on my end. Okay, great. Thanks everyone. So where do you start? What do you sell? Who do you sell to? Where do the premiums come from? How do I know what, when, and where to sell? How do you manage the risk and reward? So you need to be able to consistently do this. Automate the risk and profit controls. Be non-emotional. Keep it simple. You want to use high probability strategies over and over. You want to trade within an accommodative market. That means liquid and deep. So automate things. You want the correct position size for your trades, and you want to stagger those strikes and expirations. And basically, you want to spread out your risk. But how do you do it? We've done the testing for you, so we have figured out a fresh approach to trading these complex option spreads called Theta Trader. So it is built to sell credit spreads. We use a special algorithm we created to generate the spreads for us and to manage the risk and reward of each spread. That picture there is down on the trading floor, one of our option brokers years ago, filling orders for us. So there you see the proprietary algorithm. And we use this in bull, bear, and flat markets, and then we automate the risk and profit tracking with something called the RTI. So if you like what you're about to see, we're going to show you how to take action. So with that said, it is time to jump into the demo. Okay, now you are looking at my screen. This is a demo account. Excuse me 1 second here. There we go. Now you can see. Okay, so this is a demo account of Theta Trader, and you can see here at a brief glance the Theta trades. I'll explain that. Any open sold positions, your account info. Remember, this is just a demo account, so don't worry about the numbers right now, and current pricing. So what I like to do is really start from the beginning and look at Theta trades. You can see bullish strategies available that Theta Trader populates for us. You can also see the bearish strategies available and neutral strategies. So we talked about the condor and the dragonfly briefly. So let's look and start with the condor. You can see all of the condors populated. The algorithm built all these trades anywhere from 16 to 72 days till expiration. You can see the full trade by hovering over it there. See that pop up? So selling the 3180 puts and 3435 calls on this particular trade. You can see here the potential profit at expiration, and then this is the targeted annualized return at expiration. And don't use this number as an idea for the types of returns to expect. You can't expect that type of return. It's really for comparing one trade to another. And you're going to see the shorter duration trades are always going to have the larger TAR figure, just because it assumes you just turn those over and annualizes that return. So let's take a look. I like to look at the trades with the most time in these demos. So let's drill down and take a closer look. In fact, maybe we can zoom in just a little bit there. Okay, so first thing I like to do is look at a chart. This gives perspective, and you can see you're selling the 3560 calls, buying the 3580, selling the 2970 puts, and buying the 2950s. So that's what it looks like on the graph. Now let's go back to look at all the details here. You see 72 days till expiration. Settlement price is 2.25. Here's your maximum put risk and call risk. And then you have your cash required and then the profit potential. So here is how much is required to place the trade, about $900 to make about $90. So why would you do that? Why would you risk 900 to make 90? Well, we talked about high probability outcomes. Let's take a look. The 2970 puts are the ones we're selling, and those have a delta of 9.68. So that really means the probability of expiring out of the money is over 90%. So that's what we're talking about with higher probability trades. And then the call here, 6.94% delta. So you have about a 93% probability that this call that you're selling is going to expire out of the money. So that is the whole key to the higher probability trades that we like to do. And then this is your targeted return on cash, just over 10%. And when I show you the dragonfly, you'll notice that the condor has a slightly higher targeted return on cash, and I'll show you why. Now, it's always going to default to a sell when you're selling a condor, of course, and a quantity of 1. And then here's your price of 2.25. That's how much you're trying to receive. And if you wanted to place that trade, you would simply click the button, and there it shows up in your orders as being filled because it's a demo account. Now, let's take a look. I think the best thing to do, we have a simulator, and I've loaded some simulations, and I want to show you a few of these. These can be a lot of fun. So here's an iron condor placed September 25, and let's just follow along with these buttons here. You can press the button to play the chart, or you can go one day at a time, however you want to do things. And you can see here down below, as each day goes by, you can see the RTI is green, which means all systems are good, nothing to do. You can see the trade was a little bit negative, but now the P&L is turning green or turning profitable. And that's simply because as the market's going sideways, there's theta decay working. So as you sold these out of the money put and call spreads, as time goes by, remember we talked about theta decay. And now it turns blue, and blue means to take profits. So with about 37 days remaining, enough of that theta decay has occurred, and Theta Trader says you can take profits now, close out that trade. You realized in this case 72, 75% of the potential premium. That's what this references. And you can automate this. That is the whole key, one of the keys to Theta Trader. You don't have to watch it. You can automate the profit taking and risk management orders, and I'll show you how to do that. So that is a typical example of a condor and theta decay. I don't remember what happens here. It doesn't really matter because you'd be out, but let's take a look at another condor here. This is from a different date. Let's go ahead and play this. Sometimes people get a little complacent with these condors or anytime they're selling options. So here you go. Here's an idea. Theta Trader says, get out. It's blue, take your profits. You've reached a good point, and now you can take your winnings and move on. Sometimes people get complacent and they think, well, it looks pretty quiet. I think this market's going to just keep chopping around, and I'm going to stay with it and collect, squeeze the last ounce of juice out of that, orange. They want to capture 100%, not just 71% of the potential target. So they stay in the trade. Look at this, it's turning yellow, elevated risk. And then it turns red, and that means too much risk. You need to get out. And so what would have happened here if you would have avoided or disregarded this profit-taking signal? You would have taken a potentially winning trade and turned it into a potentially losing position by not following your risk management. So that's why we like to automate this, and I'll show you that in just a second. Let's look at a couple more condors and compare it to the dragonfly. Once again, you can see everything's green, everything looks okay. Turning yellow, and then it turns red. Too much risk, get out of the trade, take your loss, and move on. Now let me show you here. That happened on January 16 is when you had the risk signal to get out, and then take your loss and move on. So that was an iron condor. And now let's look at a dragonfly. And before we look at that dragonfly, what I want to do here, let me load this up. I want to go back to the dashboard. And let's look at the structure of the dragonfly. Just walk through a quick example. So you can see we did an iron condor. Let's look at a dragonfly. We'll choose this one here. Point out a couple things here. So the settlement on this dragonfly is 8.3 points, collecting $415. Here's your put exposure, 5,500. So this is the required capital, a little over 5,100. Your profit potential here at expiration is $331. Your targeted return on cash, 6.4%. We talked about how that's typically going to be less on a dragonfly. Now notice here we're selling the same puts and the same calls, and the 9.68 delta and the 6.94 delta are the same. But the difference here is the trade structure, where you actually buy a closer to the money call and a closer to the money put. So you sell 4 of the calls and puts, you buy 1 closer to the money call and put, and then buy 3 further out of the money calls and puts. So that is the structure, and you do this all in one order simultaneously. You can see here it defaults to sell. Quantity of 1 means you're selling 4 calls and puts. If you had a quantity of 2, you'd be selling 8 calls and puts, and then you'd be buying 2 here and buying 6 here. And then here's the price of that particular dragonfly, and you would just go ahead and place that order, just like the condor, and there it is. Okay, so with that said, let's walk through this simulation on a condor. Let's compare it to the dragonfly, compare it to the condor that we just saw. So look at this here. On January 3rd, with 29 days left, it turned profitable enough and matured enough theta decay happened so that the algorithm issued a signal to take profits. And why would this trade, now remember, November 20, 2019 is when this trade was placed, this dragonfly. And if we go back here, you'll see November 20, 2019, on the same day, had you placed a condor, you actually would have ended up taking a loss on the trade on January 16. But if you placed a dragonfly, you can see here that on January 3rd, 6th, 7th, you ended up having profit signals. So why is that? And the difference is because, remember, you are long this closer to the money strike price. In this case, the 32.90 call that you bought is 40 points closer to the money compared to the ones that you sold. So it is going to gain in value at a faster rate, or conversely lose value at a slower rate compared to the further out of the money calls that you sold. And if you keep this one up, you can see here, I want to point out that on January 16, it would have turned red, just like the condor turned red here on January 16. But the difference is the condor never gave you a chance to get out over these 3, 4, 5 days here and take a profit. And that's because it doesn't have that long, what we call inside call and put that's closer to the money. So that is a key differentiator between the dragonfly and the condor. The condor is great. We can do plenty of condors, but the dragonfly can be more robust, have a different risk-reward profile, perhaps generate slightly smaller targeted returns, but you have this potential here in situations like this to actually get out, take profits at a much earlier rate. I'll also point out something here too. The premium captured at settlement, you're thinking, well, how could it be more than 100%? Well, it's because you're actually getting paid to close out this position at this price, because once again, you are long this call option here, and that's gaining in value rapidly. So let's look at a couple others here. Here is a condor, a recent condor. Let me scroll this there, you can see now. Well, you can't see enough of the screen. Sorry about that. Hold on one second. There, now you can see. Okay, let's play that one through. And by the way, you don't have to play them through. You can just start at the back and then just go all the way to the end. It's kind of fun to play it though. So you can see this condor would have turned red on January 16 of this year. Now, what if we had placed a dragonfly instead of a condor? So here you see again, it turned profitable on January 3rd, giving you a chance to get out for an early exit opportunity. And hopefully that makes sense. I think it does. And let me show you here how to go about under my account, under settings. This is where you activate your risk manager. Check the box, you activate your profit directive, then you just save those settings, and that's how you do it. If you have a few questions on the strategies, you can just go to the help file. That's under my account, under the help file. There's all sorts of glossary information here. And here are the color coding on the RTI. And then here's a definitions for all the strategies. And then let me point out something else. There's also something called Trade Builder. So if you want to start from scratch and build your own trade, you could on any of these markets, any contract, any strategy, and you just follow the prompts. So there are trade builders available, but most people, frankly, just follow along with what the algorithm is doing. I think that makes a lot of sense. Now let's look at the positions here. So how do you track things? That's a big reason for developing ThetaTrader is having been in the brokerage industry, it's a nightmare to kind of track things on your own. So here at a glance, you can see, excuse me, all the open short position, all the open spreads here, right at a glance on the home page. You can see they're all green except one is orange, elevated risk. And you can see all the open positions in detail. It doesn't get any easier. So if you place spreads, you have a bunch of spreads. This is how you track them. Each line here represents a particular spread. You can see at a glance where they are on the RTI. You can see what the deltas are. And then you can see drill down if you wanted to drill down any further. You just click on one of them, for example. You can see the history of that trade. And then you can look at closed positions. So those are some of the closed positions from the demo account. So there you have it. That is a good overview of the ThetaTrader dashboard and the simulator. I also want to point out we have tutorials available. These are videos on how to actually use the ThetaTrader platform. We also have educational videos available here. So if you've not had spent a lot amount of time trading options, you can get up to speed here on basics of options and of course all the different strategies. And that is going to leave us saving the best thing for last. So let me show you what I'm talking about. Okay, so here we go. I think we've saved the best demo for last. So don't get overwhelmed. We make it easier. But you're thinking, okay, this is great, but I don't want to sit behind a screen all day. Well, that's okay. We know you don't want to do that. You've got your own stuff to do, your own family to spend time with, go on vacation. So that is why we developed ThetaTrader, but more specifically, it's why we developed this. What we think is our best feature, the trade alerts. This is just 1 minute trading. It really is 1 minute trading. You can just touch, accept, or reject. That's all you have to do. So these alerts are live, meaning they are integrated with your trading account with us. So all you do is you touch accept if you want that order placed, and the order is placed for you. You don't have to log into a separate platform and try to transpose and type in separate information. Just done with one simple touch. And then you saw how ThetaTrader can then automatically track your risk and profits with the RTI. So how does it work? What does it look like? Well, you receive a text message with a link. You just touch that link, and this is what happens. You can see the graph there. You get a little headline for the trade, your net premium, cash required. The quantity is already predetermined for you because, of course, it knows what you have in your account. And then if you like it, you just touch accept. And that's it. So you can look at that one more time. All right, it's great stuff. We have lots of clients using this. They absolutely love it. A lot of people just rely on it solely. In fact, we get calls later. Oh yeah, I got your alert. We have airline pilots. I got your alert. I was flying somewhere, or I got your alert. I was actually on the golf course, or I was with some family. I was with friends, and that's all it takes. You just have to look at it and touch accept. If you don't like it, you just touch reject. So, with that said, did you discover something new and valuable? Hopefully you felt it was time well spent. So we're going to have a special offer for you. There's two choices on how to get involved, the Pro Trader, the Elite Trader. Let's first look at the Pro membership. Of course, you get the Theta Trader platforms. You get all the Theta trades available every day. That proprietary algorithm will pre-build those option spreads. Simple, effective. You have that trade tracking. You saw how easy that is. Compare it to this. So here's Theta Trader. At a glance, you can see all your trades, one line at a time, see the RTI, or here's a typical brokerage statement. And I've been in this since 91, and the statements still look that bad. That's just from, I think, a couple months ago. So nothing's changed. You cannot do it with a typical brokerage statement. Then the RTI, automatically exit your trades. Use autopilot. It's non-emotional. That's the big key here, folks. And then you have the automated risk manager, check that box. Profit directive, check that box. It's that easy. Trade simulator, you saw how we ran through a bunch of simulations. Remember, these are available for back testing. You can have a lot of fun with that using those buttons to go backward and forward. The trade builder, build any trade you want starting from zero. So you have Theta Trader with the Theta Trades, the RTI, the simulator, the trade builder. Yearly value on that software, almost $3,600. And believe me, I talk to people every day and they're spending a fortune on trading tools. Now the trade alerts, remember, these are integrated with your account here with us. These trades are tailored for you and your account. They're pre-sized and they're live. All you do is touch accept. And then once the trade is filled, the RTI can then manage it for you. Trade alerts, I see them all the time. People pay quarterly, they pay yearly, monthly, whatever it is. I mean, anyway, people are paying a lot for trade alerts. Yearly value, $44.64 at least. And in fact, trade alerts I see don't work that easily. They're not integrated. And then you get those alerts. All you do is go to that same settings page, and where you check the risk manager, you just go ahead and get those trade alerts here and check that. So here you get, with the Pro membership, you get Theta Trader, the trade alerts, a value of over $8,000. So if it was going to save you a lot of time, money, grief, aggravation, it would be worth it. This little guy made me laugh, so I put him in there, you betcha. But of course, as these things say, there's more. We have proprietary research with our trade scope and daily comments, technical analysis, as well as an overview and a narrative of what's happening in Asia and Europe and in the US. Yearly value on that proprietary research subscriptions, $29.52. And we throw, of course, throw in those tutorials I mentioned, video tutorials on Theta Trader. That's all part of it. No additional cost on that, of course. So total value for the Theta Trader, the alerts, and the proprietary research, over $11,000. So even at half price, it would be a great deal. But sign up, you get the Theta Trader Pro, $497. That's your one-time membership fee, one-time payment. But we don't even do that right now. It's free. We've actually been able to have these memberships in the past. People willingly pay them. It's not a problem, but right now we're doing it, making it available free. So you see the link there. cf.altivest.com/pro TT. So otherwise, one-time fee, it's waived right now. It's available free. So if you're ready to kind of hit the ground running, so to speak, you want to use ThetaTrader, it's available for you. Now here's the real key though. This is the elite membership. This is what people like the most. You get a private coach. So you have that one-on-one training with an experienced trader. You have 1 hour sessions allocated to you on trading with ThetaTrader and stock index spreads, option spreads. So you look at your theta trades, you can do back testing with your coach, learn how to ladder your strike prices, and I'll show you what that means. Look at the technicals and fundamentals and choosing which trades, how to manage your risk and profit accordingly, learning more about advanced strategies like the dragonflies. You saw bear hedges and half dragonflies and calls and puts and so on and so forth. So you have basically a wingman here. So you have a co-pilot, a licensed professional, someone who's actually doing this for many years, not just a phone clerk. They can discuss your history, your trade history, value of at least $7,500. And I think that is way low because I know for a fact, I see people selling education and coaching, and that's fine. But people are paying $25,000 for, access to materials and a coach and that type of thing. But with ThetaTrader, we can provide that for you with the elite membership. Remember, we're talking about a one-time payment. This is not a subscription. One-time payment, $797, because we're taking 20% off till Sunday night. We want to encourage you to take action if you like what you see, and you've got plenty of time to give us a ring if you have any questions and comments. But frankly, I just did this. I had people just hitting that link and before I even finished the webinar, just signing up. So that's the best thing to do. Hit that link there, cf.altivest.com/TT Elite. If you already know what you want and you want to go ahead and jump on this, get that discount before it expires on Sunday night. That's what the order form looks like. Very simple stuff. And you do get a 30-day guarantee. Quite frankly, we've never had an issue with this at all, but if it's not for you, you decide that's fine. Let us know and we'll refund that membership fee. So there you have it. Quantities actually are limited. This is not a robo service. These are real people, and you're going to have a professional guiding you with these elite service. It's really a one-on-one approach to trading with a boutique level of service, a very high-end level of service. You want a free account, free elite membership, that's fine. $100,000 account or more, we can refund that membership fee. Now let's get some of the FAQs. I'm sure a lot of you have some comments and thoughts, but I think we can answer those here. You can have an IRA account, individual, joint, corporate, trust, you name it. And we have a little feature here called Bet You Didn't Know. Traders are fleeing the individual stock options market. Customers pulling out of equity options, trading other products. They are shifting to futures contracts. 42% increase in futures volume in April. That was from a Wall Street Journal article. And it said here the bid-ask spread has grown 30% in the past 5 years, peaking in 2014. So that's not good if you're trading individual stock options, unless you're trading the top, 3, equity options markets all the time. There's just not the amount of liquidity and depth, and therefore you don't get the execution quality. So the ES options that we trade, meanwhile, they have superior execution. They have a cost savings of $4 to $15 per contract on the ES options. So there's what we're talking about on the spread. You want that bid offer spread to be really, really tight to save on your transaction cost. So at the CME group, which is where the E-mini trades, these spreads trade as one object at one net price. When you're spread trading in securities markets, they don't have that same advantage. And then here are the hidden costs of securities trading. There's no such thing as free stock trading. There's something called payment for order flow. You don't know what that means to your result. So that means stock brokerages are paid by third-party market-making firms to route their orders to them for execution. That means your order can be ripe for exploitation. So You can get less favorable fills that cost you more money. The cost is buried in the transaction. So just because they say no commission, you still end up paying one way or another. Here's an article, Robinhood making millions selling out the millennial customers to high frequency traders, making millions of dollars in cash income by selling their customer orders to the high frequency trading meat grinder. They are not charities. The reason high frequency traders would pay Robinhood tens to hundreds of millions of dollars is that they can exploit the retail customers. Article there from Seeking Alpha. So there's no such thing as a free lunch. This here is a little bit of a harsh take on it, but it kind of made me chuckle. It says Schwab and others confirm their status as casinos, purveyors of financial opioids. No such thing as a free lunch. Retail brokerages are not charities. They will make up lost commission revenue in other ways, usually obfuscated way down in the guts of their workflow processes where few people notice. It's an article here from Paul Roade from the Tab Forum. So with E-mini futures options, the ones we trade, there are no hidden costs. These are not securities options. They trade at the CME group as an object. There's no payment for order flow, none of that nonsense, none of the high frequency trading third parties. It's one electronic market, the Globex exchange. It doesn't matter if your order is small or large. It all runs through the same marketplace, equal treatment. What about tax efficiency? Well, trading futures options, you have 60-40 treatment of your gains. So let me take a look here quickly at a mathematical example. If you're trading individual stock options, $100,000 account, 20% return, assuming the highest tax bracket, you would have a $7,400 tax liability, rate of return of 12.6%. You're trading ES options like we're talking about, you have a $5,360 tax liability, 14.64% rate of return, savings of over $2,000. Remember, these can, with futures options, you can use your losses if you have any to write off other gains, roll those losses backwards as well, consult your tax advisor, and no more itemizing. This is really cool with our space. You don't have to do any itemizing or wash sales or anything like that. You just get one number, what's your P&L for the year, plug it into your taxes. So you've seen how to become a theta trader. We have a couple other FAQs here at the end, but this is how to act now. You get lots of value either way you choose. You don't want to do nothing. That would be no fun, right? That's risk and reward free. So either membership offers value. You have the Theta Trader platform with the trades and the RTI. You have that private training with the elite members, the trade alerts, the proprietary research, the education, the tax advantages. So with that said, look at the FAQs. People want to know, can I trade stock options? No, we specialize in options on the E-mini stock index futures markets. So we looked at the ES, S&P 500. We can also do NASDAQ 100, Russell 2000. That's really the bread and butter right now. So we do this because of the high growth and volume liquidity in the E-mini options space. And those tighter spreads we talked about, you can track one or two markets, not thousands. It's convenient. There's a clear cost structure. It's not opaque. What about, can I use Theta Trader with my current brokerage? Well, we are a brokerage firm. AltaVest is the brokerage firm that developed Theta Trader as our proprietary service integrated with what we do here. So what is the performance of Theta Trader? Well, it's a trading platform for self-directed clients who make their own trading decisions. So everyone's performance is different. And a reminder here, and I should have pointed that out in the demo, all the performance calculations are net of any trading cost. So that begs the question, the commission rates, what are they? Our rates are competitive. Our E-mini rate is 5.25 round turn all in. So you might go to a big brokerage firm. I went just the other month. I go often and I look and they'll say, hey, our rate's $2.25. But look at the star, the asterisk there, that's per side. And then they have fine print way down at the bottom where they add more fees and they make the total higher than what we charge. So yes, you can find uh, commission rates that actually are lower, but we offer a completely different level of service. We're not robo advisors. This is not a chatbot window that you talk to. These are real people with experience helping to guide you. And quite frankly, our rates are very competitive because others, the big box brokerage firms, they're going to end up charging sometimes even more when you add up everything else. So how much money should I start trading with? Well, you saw about 1,000 is needed for a condor and about 5,000 for a dragonfly. So you'd want to have probably many separate trades, different strike prices, different expirations, all simultaneously in your account. So we suggest a minimum 25,000 at least. Now we talked about laddering. What do I mean by that? Here's just a graph. So here's a condor. These are just the short strikes. So the short put here and the short call here, going through till expiration. And then after a couple weeks here, it looks like February 1, then maybe a couple weeks go by and you place another condor with the green strikes here, the green put and the green call. And then a couple more weeks go by and you place another condor. And this is a blue, selling the blue put here and then selling the blue call. So that's what you mean. You want to stagger and ladder those strikes among the various expirations. That's just sort of a brief example what that looks like. So once again, to circle back, alternatives, they typically have a low correlation to traditional investments. They may improve diversification and lower portfolio risk. So alternatives can help smooth the impact of market volatility and may generate higher returns relative to their level of risk over time. So you want alternative investments that may have a lower correlation to traditional investments, could potentially reduce overall portfolio volatility. And what about growth? Well, it can hopefully improve the risk and return profile of a portfolio, helping investors' total return. So I talk about alternatives. Absolutely, this is an alternative investment space. It's an absolute return vehicle, meaning you can be trading these options and different strategies, and the stock market may be zigging, it may be zagging, and the performance of what you're doing with these strategies can be completely independent and non-correlated. Now this is interesting. I just pulled this one up, thought I'd put it in there. So here's the S&P trading here, or this orange line at the highs, and you see this dotted line here. This is the growth trend for the S&P over history. It's now at its greatest deviation from its long-term growth trend. So this gap here looks to be at its greatest gap ever, meaning, well, the implication is we can expect some mean reversion at some point. You can see here, very similar situation back in, this is, what year would that be? Back in the mid 90s, early 90s. Remember we had that recession, that's right. And then here's this, let's see, back here, you can see the market was down almost 60%. And that was 1987 crash. So anyway, that's interesting to look at. How about this? This is a compelling, actually, to really say it out loud because it doesn't sound like it. This is corporate profits here, this orange line. After-tax corporate profits, you can see for the last 10 years are basically flat. But meanwhile, the S&P 500 is just absolutely soaring. So I don't know, how long can that last? And here's some market watch pieces here. Stock market's 10-year returns exhibit a strong tendency to regress to the mean. So particularly good decades are often followed by mediocre or worse ones. So we've had a very good decade the last 10 years. Was it 30% on the S&P? Dow was something like 25%. So that's what we're talking about with mean reversion. So it says it was outstanding for equities. The next decade is likely to be decidedly less so. So how about consistently doing this? Be calm and have some allocation to the alternative investment space. So we're looking at higher probability strategies that you just do over and over and over again, kind of like the shampoo bottle says, lather, rinse, and repeat. Then also remember we talked about other strategies too, where you saw how there are things called the bear hedge or the bull hedge. You can also be directional in nature as well. So remember, we talked about taking action. If you liked what you saw, now is your chance. We saw how we can cross some of those hurdles and barriers. You don't have to worry about contradictions in the marketplace. These strategies can have non-directional biases if you'd like. Chasing past performance, we're not doing that at all. These have independent results. And emotions, we can automate things, make it really simple and user-friendly for you. So there is the lifetime membership for the Elite, $797 one time. You want to get that discount before it expires Sunday. And Theta Trader Pro, you can jump on board right now. You can access that for free. And thank you for your time. Thank you for joining us. And we'll get that recording out shortly. And we'll hopefully have a great rest of the day. And we'll talk to you soon. Bye-bye.